The effect of profit or loss on capital. Many of you will leave school and decide that you don't want to work for anyone. You want to start your own business. You will need money to start your business. This money which is used to start your business is called capital. In this lesson, you will learn the main reason people start a business. You will learn the difference between profit and loss and the effect that profit or loss has on capital. What is the main aim of a business? The main aim of a business is to make a profit. But what is profit? A business makes a profit when the revenue or money received from sales is greater than the expenditures or the cost of operating the business. Another name for revenue is income. Money earned by the business. Another name for expenditure is cost. Money spent by the business. If money earned, revenue, is greater than money spent, expenditure, then a profit is made. Let's say you bought a computer for $25,000, but later sold it for $30,000. Did you make a profit? Yes. Because you received more money for the computer than you spent to get it. You spent $25,000 but earned $30,000. You made a profit of $5,000. Let's add a little expense in the equation. Suppose you paid transport cost of $500 to get the computer to the buyer, then that $500 would have been an expense, which had to be deducted from the profit. The profit will therefore be reduced by $500. The profit would now be $4,500. The $5,000 which was made before the expense was taken out, would have been the gross profit, in accounting terms. The profit left, after expense, is called the net profit. If on the other hand, you had a hard time selling the computer, so you finally sold it for $20,000, you would have spent more buying the computer than what you earned from selling it. You therefore would have incurred a loss. With the added transport expense, you would have made a loss of $5,500. When more money is spent, expenditure, than what is earned, revenue, then a loss is made. Does profit or loss have an effect on capital? Remember, capital is the money used to start a business. If the business makes a profit, what would this do to the capital invested? Let's find out. Let us say, on January 1, 2022, Janice's business had the following assets: office equipment, $60,000. Stock, $20,000. Furniture, $70,000. Cash at bank, $100,000. Totaling $250,000. On the same date the liability was, creditors, $70,000. We know the assets. We know the liability. We can use the accounting equation to find the capital. Using the accounting equation, capital equals assets minus liability. C equal A minus L, we can subtract the liability from the assets to find Janice's capital. $250,000 minus $70,000 equals $180,000. The capital is therefore $180,000. What if, during the month of January, Janice's business sold all the stock on hand and received $45,000? The value of the asset would change. The assets would now be: office equipment, $60,000. Stock, $0 as it was originally $20,000 but all was sold for $45,000, $25,000 more than the value. Furniture, $70,000, and cash at bank, originally $100,000, now $145,000. Increasing by $45,000, the amount of stock sold. The total value of the assets is now $275,000. Because the value of the assets has changed, we can now recalculate the figure for capital. Remember, capital equals assets minus liability. So the new figure for asset, $275,000 minus $70,000 for creditor, equals $205,000. Take very good note, the old capital was $180,000. The new capital is $205,000. What conclusion are you drawing? The capital has increased. By how much? The same $25,000 profit made from selling the stock. Remember, the stock had a value of $20,000 originally but was sold for $45,000. We can therefore safely say that capital is increased by a profit. Conversely, if we make a loss, it will reduce the capital. I hope the presentation was informative and you learned something. For more information, see Sheila Robinson and Frank Wood, 2007. Principles of Accounts for the Caribbean, 5th edition. Pearson Education Limited.